Good morning. It's good to be back once again. Today I'm going to talk about the euro dollar. So let's start off by looking at the euro dollar daily chart. First of all, you can see that the euro has made a marginal low below last year's low at 112.16 made in November earlier this month. So this was a 20-month bottom. But having said that, as this level was also accompanied by what, technically speaking, a bullish convergence or divergence, as most people call it, on the daily MACD. So this suggests that we have seen at least a temporary low of recent decline, and the euro dollar should stay an upward retracement of recent downtrend. So last time when I talked about the euro about 4 weeks ago, I said that the euro would continue its recent losing streak and move lower to 111.87. So this is a 61.8% downward retracement of the entire long-term uptrend, which started in 2017 at 103.41 to 125.55. That was last year's high. So we have made a 61.8% correction of this entire rise. So what this means is that if a temporary low has indeed been formed, then we are going to see a correction of this decline from 125.55. So from the daily chart, once we can close above the immediate resistance at 114.20, then the euro should head higher towards this year's high made in January at 115.70. And a break above there would add credence to this medium-term bullish outlook. Then the euro should be en route towards 118.15. So that's the resistance on the upper left-hand corner of the chart. And after talking about the technical perspective, let's discuss the fundamentals. So today, the FOMC would start its two-day meeting, and the market is expecting the Fed to continue with its dovish hold. And if Chairman Jay Powell is going to maintain his neutral to dovish stance, then this would undermine the greenback across the board. So that would help the euro to move higher towards the two upside targets that I just mentioned. And in addition, on the U.S. Treasury yields, the U.S. yields have been actually falling in the last couple of months, so that should weigh on the greenback. And I just want to mention, although it's not on the chart, the U.S. dollar index, actually we have seen a double top formation on the daily chart. The dollar index retested last year's high made in December at 97.71 in March, but was unable to penetrate this level, and since then it has fallen. So this is a potential double top bearish pattern on the chart. So that should further undermine the US dollar across the board in the coming days and weeks. So for trading purposes, buying the euro to 113 handle would be my recommendation, with a stop below 112.50 or 112.22, the pivotal support. The first target would be 115 even, and then for position taker 118 even. And in the unlikely event the euro breaks below the pivotal support at 112.22, then risk will shift to the downside for the retest of 111.77. But this is not the scenario I am looking for. So that's my take on the euro on this show, and good luck and goodbye.